Hello everybody! Hello, good afternoon. Kali Mera Anthropos. Welcome back to Oeconomica. All about economics and finance and everything you would like to know and you need to know about the global economy and the stock market and everything in between. So if you are new here, please watch this video, subscribe. If you are watching my video, thank you very much. And thumbs up, give me a like. And yeah, please follow this video. And I have a very interesting content today about the treasury yield curve and about the stock market. And I can tell you something more about the UK gilt yield curve. I have lots of data. I've been doing a lot of work, a lot of research, and yeah, my first point of interest has been the Treasuries market sell-off, which has spooked a bit all investors and uh, commentariat and opinions and viewers and speculators and so forth and so on till the top level of the stock market chain. And yes, I've been very interested because in my previous video, back in my previous life, I've showed you the latest official data of Treasury, the United States Treasury Department, and I'll try and take the table now again. Yes, so as of January 2025 of this year, we can see that there are a lot of countries like the global economy is stuffed with the US Treasuries. So Japan is a very large creditor to the United States. It holds $1,079,000,000,000, so more than $1 trillion in treasuries. The Chinese government very generous, 760 billion of treasuries as a creditor. The United Kingdom, in the UK financial system, there are 740 billion of treasuries. Although I'm not so sure these are supposed to be holdings of foreign or non-US entities. So um, I can't say that it's the subsidiary of JP Morgan or Morgan Stanley in the UK, which has on the books the treasuries, according to this thing, but it may well be, or otherwise, the UK is the largest creditor of the United States, as well as Luxembourg or the Cayman Island, if you want to find any tax money, same as Luxembourg or Ireland or Switzerland, so forth and so on. So each and every country in the world holds US treasuries as the most liquid and important um, collateral of financial markets, more or less. Also, as because the dollar is the reserve currency. So when I saw, like everybody else, the volatility just blowing up in the treasury market, then I start to realize or think a bit outside the box and wondering if any foreign investors was becoming or getting a bit spooked and skittish about the reliability of the United States in and so like perceiving the risk of holding treasuries in adverse macroeconomic or financial stability scenarios or a lot of volatility in policymaking. There are lots of considerations, and so it seems that there is an overall trend in the global economy of trying not to be exposed to dollar assets and maybe not to be exposed to US treasuries not more than is required, or either decreasing the leverage exposure to the treasury market. Now, not for certain, because I don't work in an investment bank or in an hedge fund or the like, but I can understand why foreign investors, like global investors, would try not to be exposed to the treasury market because of many factors, either the fiscal deficit or the volatility in the United States economy or the perceived higher risk of holding treasuries going forward. So on a brief basic sum up, if you watch the other video, I will tell you now. So basically, the global economy is $31.2 trillion in investments in the United States, which were $16.9 trillion in equities. Oh, sorry about that. 12.9 trillion of long-term debt, of treasuries, long-term debt, yes, and $1.3 trillion of short-term debt. So we can see that the overall level of debt is 14.2 trillion, etc., etc. Now, when we discount for the amount of dollar investment as a United States doing productive investments or stock market investment in other countries, so the financial account of the United States still is, so here we can put brackets, or it's the same as saying minus 13.2 trillion. So actually, I mean, that's the amount that of credit that the global economy has extended to the United States, either through investing into the stock market, US stocks, or basically lending money to the United States government, or basically extending credit to United States importers for goods, or mostly goods or services. So that's the overall amount as of this year, 31.2 trillion. But when we discount for the amount of investment it does the United States, you know that the financial account position is minus $18 trillion. $18 trillion. So the United States is in debt, is a debtor to the global economy for $18 trillion. And so the first narrative that the rest of the world is exploiting the United States is totally false. It's a lie, because the global economy, we can see country by country, does dollar investments in the United States. These are official data, and all these figures could have changed because of months that go by, and then all the balances the capital flows, they change day by day, they vary day by day. But every country in the world has exposure into the United States stock market, so American stocks, or any country or every central banks holds some sort of treasuries, so United States sovereign debt or short-term debt, even corporate debt, even credit derivatives like mortgages, and even more toxic products like credit derivatives of corporate bonds, or for example in Europe, or in countries like as the United Kingdom, there is a huge problem, as well as in the United States, there is a huge problem of LBOs, which is the private equity and private credit space, or universe, or angle of the financial system, which has levered a lot their balance sheet with leverage buyouts. So many countries, the financial system is exposed to this part of the shadow banking system, which is private equity, private credit funds. And what they do, they do merger, or they acquire companies, they leverage the EBITDA of the company by 5, 7, 10 times. So they take 10 times debt, like senior mezzanine debt, or mezzanine loans, or all sorts of leverage buyout financial acquisition that the shadow banking system does. And basically all these debt exposures that private equity and private credit funds have on their balance sheet is bundled to, like exactly as in 2007, 2008, it's bundled in tranches according to ratings, and then they become subordinate or subprime bonds, which are made of LBOs, leverage buyouts, which the cash flow comes from the business that or the multinationals, or any sorts of commercial operation that has been acquired by the private equity funds. It can be like, I don't know, supermarket stores, a chain of supermarket stores, or it can be automakers or auto retailers, or all sorts of things like pharmacy chains, all sorts of, even football teams, like, I don't know, private equity funds which they go and buy AC Milan, or they buy, I don't know, any sorts of nowadays is finance is everywhere. But of course, because it's shadow banking, since private equity funds or private credit funds, they are not banks, so they don't have customer deposits. They must have some um, they must fulfill capital requirements to basically register the private equity fund. So they must fulfill some basic requirements, but then to fund the acquisitions and so forth and all this operation, they leverage their balance sheet, and often the leverage buyout it's exactly made by leveraging the EBITDA of the company that it's acquired. So that's another kettle of fish. It's in the shadow banking system. It's a huge problem that it's not easy to for ordinary people. It's not very easy to find data. But like country, as I was saying, the United Kingdom is a huge creditor to the United States. They are invested for more than $3 trillion, and in the UK economy, there have been some large leverage buyout acquisition made by US private equity funds or private venture capital, all these sorts of strange or very fancy names, which seem to be like sparkling and like gold. But private equity has nothing to do with equity or with shares, because even private equity funds, they do leverage buyout, so they use a lot of debt instruments, which are line of credits or loans that bigger banks like Blackstone or Morgan Stanley or Goldman Sachs, and so all those people, they extend to private equity or private credit firms to carry out this stuff. And it's very, very useful, because these are sorts of leverage that ordinary banks, they cannot take. And so there is all this kind of side hustle industry of the private credit, private equity, venture capital, which has offloaded off the balance sheet a lot of leverage debt that is not in the banking system, it's in the shadow banking system. And so a lot of what I was saying is that all countries like the United Kingdom, they have US stocks, they have US Treasuries, but in the financial system there are also credit derivatives which are very, very toxic. And so to say that the United States is screwed by the rest of the world, it's a lie. It's a very bad thing to say. It's very offensive and very rude, and it's not reflecting of the real thing, because you can see the data here. We have the whole world has extended $31.2 trillion back into the United States. And overall, at the end of the fanfare, the United States has a financial account position which is in the red. It's negative of minus $18 trillion. So the United States owes to the world, to the rest of the world, $18 trillion, whether it's in equities or in treasuries like Japan or China or Australia or Ireland, all the countries that lend money to the United States government and make possible for the United States government to pass the budget resolution and to have lower yields rather than to have higher yields, and all sorts of benefits that the United States economy has enjoyed for the past 50 years. So if and when all these capital flows are to be disrupted, and there is a change of perception of the reliability of the United States as an economy and in all its dimensions, then of course I would expect that investors will start to be a bit more how can I put it, they will start to take less risk. They will start to be less prone in buying treasuries, and they will probably wait and see what the market is pricing, what the Federal Reserve will be doing, what are the trade policy in terms of tariff imports, because that would then require the market to price higher inflation, lower inflation. So it's also, in terms of pricing a treasury, it's difficult because there are too many variables which are unknown, and so it's difficult to derive a certain price or a yield curve level. So maybe the global demand for treasury can cool down. Some investors, they could start to sell outright treasuries. They would start to get rid of the United States debt because they think it can be more risky, or they don't want to be tied or exposed to dollar assets. And this could be a trend that slowly builds up as investors, they seek to buy gold, for example, something that is less less disrupted by policy choices, is less disrupted as the gold prices. Basically, they are more insulated or protected from inflation, from asset prices, asset bubbles or debt bubbles, all these sorts of things. So central banks, they have been outright buying gold, or gold has been moving from the Bank of England vaults back into the United States or in other countries. So there have been a lot of parts moving, and so that's why there is a general shift in tone and in posturing in financial markets, so that any investors, large or small, they would tend or try going forward to diversify from dollar assets, and they will probably, of course, stay into gold, physical gold, or probably prefer the euro, or prefer their local currency. So they would prefer the pound or the Australian dollar or the Canadian dollar vis-a-vis the US dollar. These are trends that also reflect the idea that global trade is going to be taken with a sledgehammer and disrupted, so the end of global supply chains. So if we have this sort of destructive force, then of course we will see that investors, they will shy away from dollar assets, which are far away on the other part of the oceans, and nobody wants to have anything to do with that. And so investors, they will be more focused on their local currency and their local economy, rather than being exposed to foreign assets. So policy choices then have consequences, and if you say that the rest of the world is screwing up you, well, first of all, it's a lie, and then most probably investors, they will prefer not to be tied or have any sort of exposure to the dollar in all its dimensions. So considering the minus $18 trillion of the financial account position that the United States holds to the rest of the world, what happens, or what are the theoretical probability scenarios if and when hundreds of billions of dollars, they are dumped into the market in a deleverage sequence of treasuries market sell-off? Or even if, for example, as I said, slowly investors, they don't bid in treasury auctions. They don't want to buy US Treasury. So there are all sorts of possibilities to consider. And so I have here a lot of modeling, quantitative modeling of the treasury yield curve, and I have updated it a few minutes ago because days have gone by, and then I had to update the model up to last Friday on the past week. And okay, we can I think we can go directly on the scenario. So basically, I've theoretically tried to put together a scenario, a moderate scenario and a severe scenario of treasury markets sell-off. What have I've taken the treasuries data. I'm sorry if I'm holding you. I'm trying to find exactly the modeling that I carried through. Where it is. So as I was saying, I've applied two different variables. One moderate scenario of a 500 billion sell-off of the treasuries market, and another scenario of $1 trillion of deleveraging. Now, these are unfathomable and unbelievable market things to even theorize, but I needed something quite large to have sort of idea of what could have been the what could be the reaction of the yield curve. I'm sorry, I cannot find it. I mean, not that I cannot find it. It's here somewhere for sure, but it's very. It'll take me a minute to find it. 1 second. Right, so I had it right in front of my eyes, and I couldn't get my head around. So basically, what I've modeled through, I've used classical term structure interest rate modeling with the CIR, Cox, Ingerson-Ross model, and the Vaz-Check models. Interest rate models to forecast three kind of scenarios, which is no volatility, then moderate dumping scenario, and severe dumping scenarios. And there are already some parameters which are brought into the code, and with the live code I can of course change the parameter and say, okay, the moderate, here you can see moderate sell-off scenario. The machine works through a minimum of 50 basis point increase. I can change the variable and say, okay, I want to start from 25 basis point jump in yield or 75 basis point. Of course, I will not do this on the hoof, like, I don't know, I work for a bank. Someday you pop up and in your investment bank desk and say, okay, I take my Excel file. I don't use Excel. My quantitative modeling, it's more refined, more precise. I don't use Excel, and then I pop up and say, okay, I want to estimate earnings. And then instead of having 2% real GDP, I plug in 0.6% real GDP, just out of the blue. Okay, I plug in numbers in the theoretical, I don't know what sorts of formula you use Excel with GDP to price earnings, I have no idea. And I don't want to know what kind of rubbish is that. And then, so to set these variables, I would use a PCA. Of course, it's the personal computer. What I would use, it's a decomposition of the yield curve, where I can from where I can extract the level of the yield curve, the slope, and the curvature, and I can see what is the what are the loadings of the factors. So what is the yield curve behavior? I could also fit a Nelson-Siegel model to fit the yield curve and see also what are the other parameters. And from decomposing the yield curve, I can gather some factors, as I said, the level, the slope, and the curvature, and I can see case by case what is the level of slope and curvature in, for example, when I consider the 2-10 spread, what is the butterfly movements, like if the curve has a hump, or it's normally or it's a U-shaped, all sorts of things. So I need to do another quantitative model to inject vary the parameters here, but I would never just plug a number like that. So I'll try 75 basis points. No, I will never do that. I will always double check with the data that I have what are the parameters. But anyway, so the result that I have here on the page here, they are fixed because I had to print the result. And as I said, three scenarios: no volatility, 500 billion, and $1 trillion. But apart from the amount, what is important is that the moderate scenario has a minimum of 50 basis point jump. The severe scenario has a 100 basis point jump. You can see here yield shift. Okay, so those parameters, they are proportionate to the shift of the yield curve, which is one of the factors of the yield curve decomposition. So first good news is that both the okay, another disclaimer. So for the Treasury yield curve, it's more appropriate, it's better to consider the CIR model. Why? Because the CIR model basically uses, as in the formula, as a sigma, which uses the square root of RT, or the rates at time t. So that means that because it's the square root, so basically you cannot use negative values. And so because the Treasury, and it scales up the level of the yield curve. So because the Treasury market has never experienced negative yields, nominal negative yields, so what works better for me is the CIR model, right? Vis-a-vis if I'm doing some sort of study of the European sovereign debt market, where is the Bund yield curve, I would place a lot of attention to the Vasicek model, because the Vasicek model works both for negative and positive values of the yield curve. So that's another disclaimer. And so that's why, while you're watching the video, please just consider more what are the lines for the CIR model, the blue lines, rather than the red line. Okay, so in normal times, the forecast model tells me, okay, in the next 6 to 12 months, like for 2025, the yield curve, it should tend to slowly, the level of the yield curve should decrease slowly. That means that probably the Federal Reserve would cut interest rate. This is that would be in a normal scenario, but the Federal Reserve is actually on hold because they have no idea what's going on with the economy. I mean, they don't have a lot of certainty about the macroeconomic and fiscal policies, so it's difficult for them to have a clear monetary policy framework or scenario. But nevertheless, we can see that all the charts that give a forecast of the next 6 to 10 months, they show a downward sloping trend, so the level of the yield curve would gently decrease by 25 to 50 basis points, even more, maybe even 75 basis points in a 12 months time horizon. And then what is important is to see the shape of the yield curve, because if we go and see what will be the terminal rate in 12 months, we could see that the yield curve will preserve this sort of shape. It's a U shape. So the U shape, it's not the best thing in the world to have, and it's basically a clear expression in the market of uncertainty, because the market expects some sort of recession, and then they find difficult to move the value of the curve up and to have a yield curve which is, let's say, normally which a normal slope, or it's a normal concavity, and it's a hump to the upside, concave up. Okay, so 1 second, I also have music in my ears. Okay, so under the normal forecast scenario, the yield curve will still preserve a hump, like a U shape, not a hump, sorry, a U shape. That means that the value of the curve, the medium duration, have a negative slope factor vis-a-vis the short term and the long term, while the money market rates and long term rates, they are more or less at the same level of the yield curve. So that kind of shape of the yield curve, it basically is the visual expression of bond market uncertainty and also distress in money markets. And because basically it's difficult to price monetary, not it's difficult to price the economy in the medium term, because in the medium term we are expecting some sort of slowdown or recession, and it's also difficult to price the slope and the curvature of the curve of the yield curve between the medium duration to the longer duration. And that also is a sign of distress, because short rates are higher, so lending or access to credit in short term still it's at a high level, and that means that investors, they have some reluctancy in the overnight, for example, overnight repos or overnight funding in the banking system. Like, those are severe scenarios, but the U-shaped yield curve, is an expression of uncertainty, also uncertainty which derives from a moment from where the central bank probably is moving from a restrictive monetary policy to a more normalizing monetary policy, or to the optimal level of interest rate. But also it reflects distress in the market, because you have an inverted yield curve between short term and medium duration, and still you have volatility, higher rates for the longer duration. So the U-shaped yield curve is not an ideal place where to be. So again, the baseline forecast scenario tells me that the yield forecasts would see the Federal Reserve decreasing the interest rate by 30 basis points, maybe 50 basis points. If we consider, for example, the 1 year, that would be 75 basis points, because the 1 year is the most for the money market short-term notes, they are well anchored to the Fed fund rate, but the 1 year is the most reflective of forward-looking monetary policy stance in 1 year time. Okay, so the forecast yield is 3.65, let's say 3.70s. So if the Federal Reserve is 4.33, that would mean a 50 to 70 basis points reduction according to my modeling. Not my modeling, so I have only taken the real data and I put it through a quantitative model for interest rates and yield curve term structure, and then I've got some output that I need to consider carefully and understand what are the outcomes. And as you can see, that the red line is the forecast scenario, and it shows some sort of basically it doesn't show a normal yield curve like this. Still it preserves a U-shaped yield curve, but with a lot of mispricing, like a very unusually shaped yield curve. So it means that according to the daily yields and the volatility of different treasuries duration, then the models basically struggles to price a normally shaped yield curve. But nevertheless, it continues to forecast a decrease of interest rates, so without any exogenous variable or any macroeconomic variable, whether it is GDP, inflation, or employment, unemployment, etc., etc., then the scenario is for some sort of reduction of interest rate, and a firm anchoring of the medium duration here around 3.6%, but still a U-shaped curve, which means that there is uncertainty and a sort of stagnating economic environment with short-term rates higher, a belly of the curve which is here, so you have a negative slope, a negative curvature, and then here is somewhat of higher, still higher long-term bonds. And those are the forecast yields. So the terminal rate for the 10, 20, 30 years still will be very, very high, nevertheless, maybe even higher than what is the yield curve today. Now, Going to the moderate scenario, on the moderate scenario, consider a 50 basis points jump in terms of volatility. And so the 500 billion is just a dummy variable, an exogenous factor. So because for $500 billion of sell-off in treasuries, I think that 50 basis points jump in yield maybe it won't be enough. It would be much higher, but nevertheless you can see that the spread widening, the gap widening between the level of the yield curve today and what will be a moderate treasury market sell-off scenario here. And you can see that you have those three factors that move together and they try to give a shape to the yield curve. So that means that you have a shift, a level up in the yield curve. The whole yield curve levels up as a shift up in the level of the yield curve. So all yields, according to for all maturities, they go higher. So the cost of borrowing increases a lot. You can see 1,000 basis points, a full percentage point. So it would generate a much higher cost of borrowing for the US government. But then, the most profound effect is that the Federal Reserve money market rate is 4.33%. If and when there will be a sell-off and the investor would be selling also short-term notes, then the yield in short-term paper, even the 1 year or 2 year, they will diverge a lot from money market rates. But what is most important, of course, are these. So the money market rates that will diverge a lot to 5%, 5%, 5.5% from the Fed fund rates. And that will cause all sorts of havoc and disruption and dislocation in money market and for funds which have their funds exposed to interest rate swap agreements. If they are paying a floating rate, then the floating rate will jump enormously, and so the premium of the swap will go up, and then you'll have all sorts of margin calls on one side and the other. And then also funds that are leveraged on treasuries, they will see that the value of their collateral will plummet, so they will have margin calls on that side to shore up the value of the collateral that it's plummeting a lot. And so that will translate they will have a ripple effect for the stock market. So immediately all funds and banks, they will have to dump all stocks, all risky assets, gather liquidity and cover the margin calls. So the theoretical scenario of a huge bond market sell-off and the treasury market sell-off would cause a lot of disruption in financial markets, and of course a repositioning of investors that would try to deleverage their assets from dollar-denominated assets from US Treasuries. So if investors, they are seeking to exit, to dump US Treasuries, not to be exposed to US Treasuries, that can have a lot of ripple effect in markets. First of all, would basically generate a lot of problem for the Federal Reserve, which will see short-term rates diverge by more than 1% from money market rates. And then all the derivatives market, the interest rate derivatives market, would see a huge volatility dislocation that can basically blow up interest rate swaps. And you will have, as I said, all sorts of margin calls, whether it's swaps or it's treasuries as collateral. And then all funds, they will start to sell everything, even without watching what they're selling, even without checking. They will dump everything to get liquidity and cover the margin calls. So that will be, and of course the consequences will be immediate in the bond market. You will see credit spread jumping a lot. You will start to see high yields and junk credit to jump a lot, so you'll have a huge widening in credit spreads, and probably that will reflect the real state of the economy. If the economy is going into some sort of a stagnating patch, slowdown in economic activity, slowdown in all sorts of global trade, in commerce, and all sorts of things, in a period of prolonged uncertainty, then of course credit spreads would jump a lot. With that also CDS, credit default swap, start to jump a lot. And as I said, then you have that part of the shadow banking system, which is a huge amount. We are in the trillions of dollars of private equity, private credits that they have those credit derivatives, which cash flow is the cash flow of, I don't know, supermarket chains. It can be Morrison's, or it can be Boots, or it can be any sorts of multi-store business. And if the economy goes haywire into recession, there is less spending, then those huge, those large businesses which have multi-store operation, they will have lower cash inflow. That cash inflow, it's a lower EBITDA vis-a-vis the leverage buyout of the private equity fund, and you can see how the economic downturn can then become a very toxic effect for the junk credit derivatives. So treasury market sell-off, it's a huge thing. It definitely sends the global economy into recession. It would change the composition of the balance and the equilibria in the global financial system, because investors, they will take a position, they will take a momentous, a big moment decision to move away from dollar assets, from excessive leverage in the treasury market, and so they, of course, probably they will take a loss if they will have to sell a lot of US Treasuries all in a hurry. But then you will see I think I have here, so what will happen is money market. Do I have pen? Okay, I don't know if I can use it here. Okay, it's useless, it doesn't matter. So money market, the Fed fund will see the 1 month T-note, T-bill, or 3 months or 6 months T-notes, they will jump a lot. They will dislocate immediately from the Fed funds rate. And so all money market funds, they will basically see their cost of rewarding their investors to jump by 1 percentage point, and so that will be already a sort of liquidity distress for money market funds. Then you have all the parts of the financial system. So all bonds funds or investment funds which are leveraged in with treasuries, or they are leveraged through replicating treasury exposure with interest rate swaps, they will see huge margin calls because their floating rate, they will pay more. If they are receiving a floating rate, they will receive more money, but the value of the swap will go down. So everybody will have a margin call on that from that point of view. Investment funds which invest in stock portfolio and ETF portfolio, and they basically, the structure of the fund is to leverage repo their or leverage their treasuries as collateral to have cash and be all invest in stock. The aftermath of a 500 billion treasury sell-off, even $1 trillion treasury sell-off, will mean that the value of the collateral treasury will go down. So the investment fund will have to immediately dump all stocks, go to cash, and cover the margin call, the collateral decline, the price decline of the treasury, which is the collateral of the fund. And so, and then there is the last but not least effect is that all those parts in the shadow banking system, which are leveraged on the economy and they are leveraged on debt, they will go through a huge issue if basically the EBITDA or the cash flow that comes from their acquisition will start to decrease, and their leverage, their cost of borrowing will at the same time go up. So probably the value of those credit derivatives, which are the LBOs and the which I believe they are made of CDOs, collateral debt obligation, that will go down. So that part of the market will go under huge stress. So it's a proper financial crisis that you will have if and when part of the world will decide, okay, we don't want anything to do with the United States debt. And you can see here the column of the forecast of yields. I have no idea. I don't know if the Federal Reserve says, oh, I will step into the market. I'm sure the Federal Reserve could not do anything in the first instance, because all it will happen is probably they will action some swap lines and some repo things. But even if they do the repo window, you will jump out of the window if the value of the treasury, which is your collateral, goes down by 5, 10, 15%. So repo will not, unless they will do a repo and say, okay, I will take the treasury at face value, and so the Federal Reserve will buy a treasury which is worth, I don't know, $80, but they will pay 100, or they will pay the face value. They could certainly do that to save a huge financial crisis, but of course that would not be enough, because something like between $1.5 trillion of treasury market sell-off, it's very, very large. And so of course there will be a financial crisis mode and the economic recession mode and all sorts of consequences. I have no idea. A scenario is pretty much clear. A huge distress in bond market, in credit derivatives, in interest rate swaps, in private equity funds which are leveraged. Nevertheless, I have to consider this kind of scenario, not for any particular reason. It's for my idea of what can happen in future, and so that I'm not unprepared. Okay, so what the simple modeling shows me is that the yield curve jumps up, of course, and that there would be a huge mispricing in the level of yields, and you will have some sort of the curvature of the yield curve. The second derivative of the yield curve will have a sort of butterfly effect. Yes, butterfly effects, like you will be long the middle of the curve and you'll be short here and here, be long calls on treasury futures, like the 1 year, 2 year, 3 year, 5 years. If you have that sort of stomach, you will be short calls, short the short-term paper and the long duration treasuries. So that's the butterfly effect that the yield curve, the second derivative of the yield curve does does give expression to. From the mathematical terms to the shape of the curve, the second derivative basically describes if the curve is U shape, or it's concave up, or it's convex, or it's a inverted yield curve. And with the curvature you have the slope, of course, of the curve, which is the first derivative, yield, derivative of the yield on the basis of time derivative. Then again, same scenario. Remember that the 1 trillion is only scaled to 100 basis points minimum jump in the yield curve, and again the short-term paper would jump to 5.6. I believe they could even go as high as 6%, and of course you'll have an inverted yield curve, still sort of U-shaped here, and a huge jump in long duration, like the 10-year would go, the 20-year 6.3%, the 10-year is 6%. So only the 1 month will jump 1.3% here, 1.3%, well above what is the federal fund rate, and that would cause huge problem. Like, as I said, money market funds, they are paying 4 and a quarter to their customers. If overnight they will have to pay 5 3/4 or 6%, I don't know if it breaks the back, but that would cause all sorts of problems. And as well, if you have swaps, somebody's paying fixed rate, somebody's paying the floating rate. Who's paying the floating rate? You will see the premium, the rate, the premium to pay to skyrocket, and the value of the swap to go down. So margin call, as if the never-ending margin calls. If funds that are investing in the stock market and their collateral is treasuries, they will see the value of their collateral basically decline a lot, so they will have another margin call, and so you see banks which have a lot of unrealized losses of holding US Treasuries. They will see their unrealized losses just go much deeper into the red. That will cause all sorts of problems for banks, all sorts of liquidity stress, even in the overnight Fed fund rates. They will cause all sorts of liquidity mismatches in the banking system. Some banks they will be shorts, the shorting of liquidity. They will not be able to match assets and liabilities, their cash flows or outflows, and the level of asset that they have on the books. And so the treasury market sell-off, you are basically destroying the pipe system of the financial market. Not destroying, but you are severely creating a huge volatility distress that would create a huge volatility distress in market, an immediate short-term financial crisis that would become an economic recession. And that's for sure. That's really for sure. And but nevertheless, and I can see basically with the basic scenario of 100 basis point minimum jump, what can be the level of jump in the yield curve. And so if I was doing stress test scenario for, I don't know, the Norway's sovereign wealth fund or PIMCO, very large systemic bond funds, and I have to do this sort of quantitative stress test scenario, I want to have a quantitative measure of how much the yield will jump. So if I know that the yield of the 10-year treasury will jump by 1.6%, theoretically, okay, I will have to price accordingly, if I can, my what sorts of edges I will have to put in place. What would be the shortfall, the expected shortfall, the VAR or the expected shortfall of the treasury portfolio, all sorts of liquidity stress, which I'm not sure, because I don't work at PIMCO. I'm not sure these people, they do. And I think if they don't do it, they are very complacent, because the Federal Reserve, like most of the central banks, what they do is they do stress test for recession, okay, or for liquidity crisis, and usually, I'm having my chewing gum. When there is a recession, you have lower inflation, and so tendentially the yield curve tends to go down. I mean, yields tend to decrease. That means that the yield curve is discounting a lower rate of growth in future. And the paramount example of a recession is the inverted yield curve, like this one. Yeah. So when the economy goes into recession, all financial markets operators, they know that you have an inverted yield curve. So long-term rate of growth, it's a very low inflation, low economic growth, and then you have higher short-term rates, which are reflective of short-term money market and liquidity distress, because a recession also is a function of a credit crunch. So, but, and it's a huge but, I've never heard or I've never seen funds or central banks which are pricing for a huge spike, a huge shift up in level of the yield curve, like a credit crunch which derives from a huge widening in the spread of the sovereign debt yield curve, which happens, like this Greek case, yeah? Or, I don't know, Sri Lanka, or very extreme stuff, which you say, oh, it could never happen to me because I'm the United States, I'm a AAA treasury market, but The thing is that 28% of the United States outstanding public debt, it's owned by foreign investors, which are giving credit to the United States, we are lending money. And so if for some sort of known and unknown reasons, you will find that even, for example, Japan would start to sell treasuries because, I don't know, they have a problem with depreciating yen. If the yen starts to plummet, then they will have to sell treasuries, they will have to sell dollars in order to prop up the yen. Let's make a simple example. So if there is a huge wave of selling of treasury in the market, then the stress test scenario is yield curve up. The level of the yield curve, it's up. What is the slope of the yield curve? Okay, the slope of the yield curve, it's negative here, because you have recession. You will have probably a negative curvature, because it's a U-shaped, and then you have a positive slope here. But, I mean, what it's important is to quantify the level of, if ever possible, to quantify the level of jump in yields and what sorts of dislocation that can cause to, as I said, a fund like PIMCO, I don't know, BlackRock, or even any like Deutsche Bank, or these huge systemic financial institutions which hold a lot of treasuries, and they have all sorts of interest rate derivative swaps and all sorts of amenities and credit derivatives. So I think I'm sure it's very important to try to figure out these kind of things and how you will have to prepare contingency for that sort of scenario, which is not unthinkable. Frankly, it's not something that I would just set away as that can never happen. Most usually, black swans are exactly those things that you say, oh, that can never happen. And so those are the black swans, of course. And okay, so as I said, in a huge treasury market sell-off, you'll have credit spreads widening. Now it's important, the chart here, it's in no way linked to the modeling that I carried through here with the forecast CSS. No, these are basically the latest data and the latest credit spread without any exogenous variable. And as I said at the beginning of the video, credit spreads, they have slightly drifted, they've been drifting up. So these are AAA or BBB corporate bonds yield, and so that means that even the corporate bond market, it has begun to price some wider or higher credit spreads as a sign of distress, or pricing some sort of higher premia for corporate bonds issuance. Corporate bond yields, you see the line here going up. So it means that higher yields have been required for corporate bonds, higher than usual, than in a longer term trend in the past 12 months. And so I gathered to have also the charts of high yield bond spreads. You can see the high yield market jumps more than corporate bond market. You are at 5% here. So high yield bond spread, they already jumped at 5%. That's just the spread. It's only the spread. So if the Fed fund is 4.3% plus a 5% high yield spread, you are talking about the high yield bonds, they are between 9 to 10%. Okay, so if I consider the LBO markets, the leverage buyout market, and if I have a high yield leverage buyout market, which is made, high yield is made for senior and junior mezzanine loans, which are wrapped together, and then they become a bond, an obligation, a convertible bonds, a callable bond, or they become a collateralized debt obligation. And the cost of borrowing for a leverage buyout, it's 9%. And then that 9%, it's 10 times, no, let's make it, okay, it's 7 times EBITDA. Okay, so that means that the private equity fund or the private credit fund, it has a borrowing it has on the books it's carrying a borrowing cost of 9%, 10%, and it has leverage 7 times what is the EBITDA cash flow of the multi-store commercial operation that they want to acquire. But the most recent LBOs, they were even 10 times EBITDA. So you can see how magnifying is the leverage effect when you already are these sorts of you have very not very high, but there is already some sort of considerable high yield spread or even corporate bond spread. But if it's a leverage buyout, I would rather price it for high yield bonds rather than a corporate bonds. Cannot be a corporate bonds. So if I have a borrowing cost which is 7%, 9%, 10%, and then I'm 6, 7, 8, 10 times EBITDA leverage, then it's a huge problem. I mean, if then this high yield spread will start to go up because you have a treasury market sell-off or you have a liquidity crunch, then I mean this private equity fund will basically everybody will see that they are swimming naked. They are totally leveraged. They made acquisitions which make no sense, and it was possible for them to do that because, of course, because they are not banks, they are not so constrained by so strict supervisory scrutiny by, I don't know, by I mean the supervisory authorities, which I don't know. Not I don't know. I mean, for the euro area is the European Banking Authority. In the UK is the FCA. In the United States, okay, is the SEC or those kind of supervisory authorities that go and check very carefully what is the leverage and the yield, the borrowing cost that this shadow banking system is carrying through, and how they are leveraged for the cash flow. So the high yield market and all the corners of the high yield market, that will be very, very an interesting playground for investors, and I can't imagine what sorts of amenities will come out from there. So as I said, to identify the parameters for the interest rate term structure modeling, it's possible to use another model, which is this one, the PCA model, the decomposition of the yield curve. And you have basically the level factor. As I said, you have the level of the yield curve, which is a synchronized moving up or down of the yields for all maturities in the yield curve, and that is linked to monetary policy. So you can see if, how much the level of the yield curve is influenced, it's moved around by monetary policy or by inflation. So for you can see here the level factor for the 5-year or 7-year or the 3-year, it explains 35% of the yield curve shift up or down for the belly of the yield curve, the medium duration. And then according to the data that we have now, you see that the slope at the 5 of 7, it's negative slope because we have the U shaped here. We have a convexity here, which brings the medium duration of the curve down, and then we have longer duration after the 7-year, which has a positive slope. Also, you see the 3-year, the slope is marginally positive, so it's that means that it's quasi flat. I'm not doing it properly. Let's say that's 5-year, so the 3-year it's here, yeah. So no, sorry, marginally. So it's here like this. Sorry. It's difficult with very yeah, marginally positive slope for the 3-year, and yeah, sort of. I'm sorry if I'm not completely exact, but that's what the parameters tell me. Is that if you have a negative slope, that means that you have an inverted yield curve. So of course, we know from the shape of the treasury yield curve that we have a convexity in the middle, so we can expect that the 5 and the 7, they have a negative slope. It's a negative first derivative, basically. And the 3 here, it's a slightly positive first derivative. Oh, okay, yes. And the curvature is negative, which it's a negative second derivative, which means that we are here in the curve, like it's a minimum point, and then the curve starts to slope up. Okay. So the slope factor, and that's important because it helps to navigate the 2-10 spread, which is the most looked at spread. Although I prefer to give more attention to the 1-year Treasury yield. Rather, the 2 it's important, but I give a lot of attention also to the 1-year 10 Treasuries, 1-10-year spread. To me also is a very important barometer of monetary policy and what potentially is the yield curve discounting for the economy going forward. So short-term paper, that's the level of the yield curve. It is all a positive sloping, and although here we see that the curvature is negative, so we have a positive slope, but the curve in the front end of the curve, as we go towards the 1-year duration, then we see that the curve starts to turn down, exactly for the negative curvature, the negative second derivative that we have in the medium duration, and the U-shaped curve, which, as I said before, defines exactly the uncertainty, the stagnation patch that the quagmire which is in the economy in, like short-term, because investors, they are pricing short-term recession and higher growth, but the higher yields in the long end of the curve, they are more reflective of term structure risk premium, financial risk. Okay, so it's collateral risk of the 10-year Treasury is a risk, is a financial risk. So that's why the U-shaped curve it's not that great. It's as bad as the inverted yield curve that prices recession. But the U-shaped curve has an additional feature, which is financial risk, because long-term rates, they still price higher inflation for longer, higher rates, and then the longer is the duration, the higher is the sensitivity of interest rate volatility. And so there is another layer and component of financial risk, because, as I said, as you all well know, the Treasury market and the 10-year Treasury is a collateral for liquidity, and so the higher long-term rates also are a signal, are a market data that prices in higher inflation, higher rates, and higher financial risks in terms of liquidity and collateral. And curvature factor, and as I said, butterflies moves, and the butterfly moves, of course, that is defined because in the curvature factor, if I can say it, we have very short money market and 30-year. And you have, of course, there is the level factor, the slope. So the 30-year, it's lower than front. It has a negative slope in the positive curvature. So the curve still goes up, but theoretically, I don't know if in practical terms, but the 30-year yield it should be a bit lower than the front end of the curve, some sort of. That's what, and as I said before, the butterfly effect, it's basically going long the middle of the curve and going short called the front end and the long end of the curve. That's the butterfly effect. And the decomposition chart is that one. Then there is all sorts of varieties of data, the basic statistics and stuff like that, and volatility analysis for all the factors across time. That is in the past period from 2022 to 2025. So in 2022 there was a very high level of volatility because you have an inflationary shock. So the Federal Reserve starts to hike interest rate by 50 basis points, and so you have very high level the yield curve is going up in level by 50 basis points all at once, so it totally shifts up the level of the yield curve. The shape of the yield curve starts to change because you start to have an inversion of the yield curve, so you have a negative sloping yield curve. And the second effect derivative, it's probably that you have a flat belly in the yield curve, and all sorts of how the parameters and the first and the second derivative, they basically give out some other results, because it's effectively it's a mathematical process. And the volatility analysis is interesting because it tells us what is a threshold of volatility, and how if we go above that threshold, maybe it means that the market it has started to move in a certain direction. And also, yeah, we have the stress scenario. It's not based on any monetary amount, but it's based purely on 1, 2, or 3 sigma here, on the upper bound and on the lower bound. Okay, so you have a range here. The black line is what is the yield curve now, and the other dashed line, they are high vol, low vol, that sort of thing, and up to 3 standard deviation. And let's say that a 500 billion treasury market sell-off, it would be a 3 standard deviation jump in the front end of the curve, like the Fed fund rate or the 1 month T-note will jump from 4.3 to 5.5%, and maybe the 1 trillion treasury sell-off, that would be very, very big event, and I don't think that will be possible. And so under a normal market stress scenario, the 3 standard deviation then becomes a huge factor here. It's basically, you can, if you see here the green line here, you see how jump high, yeah, close to 5%. The long end of the curve will be on 5%. The short term rates will be 5.5%. So they will be huge for markets. And so that's very, 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 absolutely, totally, incredibly interesting to see and measure. Also because in these uncertain times, we really don't know what to expect from financial markets and from policymakers. And yeah, as I was saying, that basically the slope, these are things that I'm not pretending to explain anything to anybody. These are things that everybody knows. The slope is the first derivative, so is the derivative of the yield time t based on time, okay, with respect to time. So with the slope of the curve, we can measure if the yield curve, it's normal here yield curve, or if it's an inverted yield curve. So the inverted yield, with the slope of the curve, the inverted yield curve, the slope of the curve, it's negative, it's less than 0. So you know that by the slope factor, you know if there is an inversion at some point in the yield curve across maturities, across durations. Then the curvature, which is the third factor, is the same thing, is the same derivative, but it's the second derivative. Y tau dt, right? Okay, and the curvature basically tells us if we have a hump in the curve here, so it's concave up, or we have, let's say, U-shaped curve, or we have convexity in the curve. Okay, so if the second derivative is less than 0, we have convexity. If it's positive, we have a hump in the yield curve. Okay, and with these two basic things, then we know from the first and the second derivative, we can understand the shape of the yield curve and what is the theoretical hedging position that you can take according to what is your bond portfolio. And last but not least, the butterfly effect, which refers to the second derivative, it's basically when you consider the 2-year minus the 5-year, 5 plus 10-year. It's similar to a butterfly option strategy, sort of. Yeah, because you have positive yields here, positive and negative curvature here, so negative value of the curve. But lower yields, it means that you want to be long, medium duration, like 2, 3, 5 years, and you want to be short money market and short long duration in terms of bond prices. Well, these are the basic thing of yield curve understanding that I'm sure basically everybody knows at this point in time. So I want to show you another thing which has to do with the stock market. Rather, now that we are cooking with the gas and we are talking about derivatives, so I want to share with you a chart of the stock market. And what I'm saying to you is not investment advice. I don't just go to your private banker, whoever is your investment banker, whatever. That's not investment advice. I'm not inviting you to put any money in the stock market. Just keep your money for you. Don't give it to anybody. Don't speculate. Don't do that thing. Because it's for sure that it will be very disappointing. So I want to share with you some thought about the usefulness of technical analysis and the usefulness of calculus. Because that is very, very funny indeed. Okay, let's wait for the internet to help us a little bit. So that, okay, yes, I have some sort of draws, and we will go to this to the draws in a blink of a second, in a blink of an eye, or in a split second. Okay, so that's the S&P 500. Everybody knows that, and if you are doing technical analysis, you will do this, right? You will do this. Oh, it was frozen for a minute. Okay, and say, okay, that's a what was a resistance level in 2022, that's become a support level. Okay, so the way I look at these things, it's not by technical analysis, but it's from a mathematical point of view. And so it's you don't need any sort of high-level calculus to understand that. But what you see here, which was the peak of 2022, is that you have a sudden and a sharp change of direction. Okay, so it means that at this point, when you go from up to down, the market goes haywire, and basically pricing the S&P 500 becomes very, very difficult, especially here at the exact point, which is a angular point, or a point of turning from the trend that goes up to down. But what people say, okay, I have a V-shaped recovery. Okay, the recovery, I don't know, it's the recovery fund, I don't know what it's V-shaped recovery. For me, that's an angular point, or it's a cusp, or it's peak point, and then peak and trough, sort of. It would be acceptable for me. I'm becoming very, very nasty. But that's an angular point, a cusp or something, where you have a sudden, an immediate and sharp tight angle change of direction of the trend line. Okay, now we have to consider that the trend line, it's not a trend line per se. The trend line is a stochastic differential equation. So, as I said, it's not something very difficult. If I basically look at my notes, but you can go and check the website. So we have ordinary differential equations, which are f of x, y, and then you have, I don't know, what can I say? Y second plus y prime plus 2, right? Okay. You solve the differential equation from with y of x or y with respect to x dx dy, and you come to, you can have one solution, two solutions, you have negative solution, which is basically you need trigonometry to solve the imaginary part of the, when you have the square root of minus 2, then that's equal I2 plus or minus the solution, so you will have cos something, cos e to the I2 plus sine e to the I2. I'm basically, not basically, but it's very I'm not sure that's the solution, but something like that. So the stock market, it's a stochastic differential equation. That means that the differential equations takes into account the mu of t and the sigma of xt, let's say, that's more correct, and sigma xt. So what basically the stock market does is to price the average, the mu, which is the average stock price of time, and the volatility. It adds a drift term, which is the volatility of the asset, x of t, right? So the most known equation are the Brownian motion, but the Brownian motion is not a derivable function, so we need a function of this sort, which is dx of t, which equals mu, this should be a mu, x of t, dt, dt plus the drift term, which is sigma, x of t d wt. Now wt is a Wiener process. Okay. Now this Wiener process, which is a Brownian motion, is another differential equation. In real terms, here in the real world, because I'm pricing the stock market, it's trying to price with the time, with the derivative of time, with respect to time, the average price of the asset plus the sigma, which is the volatility effect. Okay. Then the Wiener process in itself is not really a it does not have a derivative at all points of the trend line, which is a function. It's a SDE, stochastic, because it's a randomness, and it's a differential equation that injects statistical parameters, which is the average, the mu parameter, and the sigma parameter, which is the volatility and the average price of the financial assets. So the SDE is the plumbing of financial engineering. Okay, everything that prices financial assets, even algorithm trading, they derive their pricing methods, their algorithms, mathematical structure from the Wiener process, the Brownian motion, and from what is the Ito lemma. Okay, so because we said that the WT, the Wiener process, does not have a derivative at every point of the function, we will have to apply another formula, another method, which basically it's called Ito's lemma, and it allows us to take the derivative of the function of x of t with respect to t, whether it's we are considering the mu parameter or the sigma parameter, which is the volatility. So basically we take df x of t and t respect to t. And if you go on the internet, if you I don't know, go on Google and type Ito lemma, then you will find what I'm trying to to write down here, although I don't have a pen. df dt plus mu, the mu parameter, which is the price of the stock. So the derivative of the mu parameter df dt, df dx, I'm sorry. Because now we can derive for x plus 1/2 sigma square, which is the drift parameter, and we take the second derivative of the drift parameter d2f plus dx square in dt plus sigma df dx d of wt, the Wiener process, the derivative of the Wiener process. What we do basically, if we substitute the Wiener process in the e dot, and then utilizing the exponential, we are able to carry through the derivative calculus, the derivation of, and then we can know what is the derivative of the first and the second derivative of the price with respect to time, and then we can do the second derivative of volatility. And basically what this gargoyle here becomes, it's what makes possible to price financial assets, which are basically, you will tell me, oh, okay, I don't need that because I open the order book and I see the volume and of bid and ask. Okay, but the process of pricing of financial asset is a differential equation which has to put together the average price of the financial asset plus a drift factor, which is the volatility. And so what is backing all of this, it's a differential equations. Now, why I have done all of this disaster, and I can show you what is the simplest formula. Once we basically substitute the Wiener process with the exponential, then we have the classic Ito lemma that basically allows pricing of financial assets. So we have a much easy equation, df dt 1/2 a second. Oh dear, I should buy a pen myself. Okay, I can do like that, so much easier. Second derivative of the function with respect to the second derivative of the Wiener process, all in dt that's the with respect to the derivative to time df dw dwt. But we have to basically assume, the first assumption is that f of t equals e wt. So when we go and we do this function, the differential function, we don't use wt, but we use the derivative of the exponential, which is still is e wt, is the same. So it simplifies a lot the calculus, basically. That's the idea. So why I'm saying that, because basically what happens is that you all know that to have a derivative in a curve, you need to have a continuous function to derive the function at any point. Okay, so to take the derivative of a function, the function has to be continuous at that point. And so when the function it's not continuous, then you don't have the derivative. If that's correct, that means that the derivatives of the right side it's not equal to the derivative of the left side, and if you take the limit for, I don't know, plus infinity is not equal to the limit, I'm sorry, if you take the limit of 0 plus, let's say, or to the right side, it's not equal to the limit of minus 0, that sort of thing. So the limits are not equal, the derivatives of each side, derivative from each side is not equal in the curve. That means that at that point, the function is not continuous, there is no derivative. Why I'm saying all of that? Because as you all know, that sort of thing, okay, here I don't have a derivative. It means that, or here, the curve, the trend basically shifts the angle so rapidly that pricing the derivative here or here or here, it's very, very difficult. Okay, and if you try to price the derivative, then you will have, for example, in the option market, you will have a huge jump of the delta or the gamma, and basically it's the value of the delta or the gamma of the Greeks. For that point, it will change quite rapidly, and the spread of change of the delta and the gamma can be large. Okay, because in option pricing, the delta and the gamma, even if the market is very volatile, you have a lot of implied volatility, or the implied skew volatility. The delta and the gamma, they vary according to the change in price. Okay, and the gamma is the second derivative of the delta. But when you go and but when you have basically, when you go and take a derivative here, then you can see that the line goes up and then down. So the delta here and the delta here, they have a huge gap in value. And so that's why here I don't have a correct and the smooth pricing of the derivative in the derivative market. And in that respect, for the derivative of the function, which is the, let's say, the trend line of the S&P 500. So why I'm saying that is that here for me is not a point of support or resistance, that it's a point where the market has not been able to price, it's priced the derivative, but you have so much volatility and a sharp change in trend that if the delta of the call here it's going up, and then all of a sudden on that side the delta of the call it's going down by huge spread, huge margin. And so that means at this point, which is a point of turning the cusp of the function, the function that it's pricing the mu, the average S&P level, and plus a drift parameter, which is the volatility. When I go and take the derivative at those prices, then if I take the Black-Scholes formula, and if I do here, what we have? If I do 48, 75, I don't know, minus 5,000. No, I don't know. I'm gonna make a mistake for sure, because I cannot do it like that. But basically, when the Black-Scholes formula, or not the Black-Scholes formula, when the algorithm of the derivatives market is to price the delta here on this side of the curve, and on that side of the curve you have a huge jump in the delta and the gamma, and so that means that here, if you have a strike price here in the option market, it's very, very volatile and it's very difficult to price. And there is the derivative, because you can price the market still function and price the derivative, but it means that the jump in the price or the volatility, it's very high. So that's why you have what is called a support or resistance level, because here it's a point where the market changed direction. Okay, so first thing first, I will never have a bet here or here. I will never place a bet, even if I take the trend of the market. I will never choose a strike price which is at the point of cusp, a peak or trough, because at that point the Greeks, the delta and the gamma, they change in value quite rapidly, and even if you have a very sophisticated option pricing model, which is the Eston model, some Monte Carlo simulation model, they will make very, very difficult even for the machine to price the derivative at these points. So when you are at a point where the function change direction, you don't have a clear derivative pricing. And so it means that the market investors, they don't behave mathematically. They don't behave mathematically because they behave on market sentiment. So what they believe that here it's a support level. But it's not that it's a support level. Here is that the market, the S&P 500 or even the Nasdaq, let's take the longer chart. Okay, the Nasdaq here changed price quite rapidly. Yeah. Now if we take the line, we can just take the line rather than the bars. You see here that the angle of the trend line, it's very narrow. So you have a sharp, sudden, and very tight angle change in trend. That means that at this point, at that point here, to price the derivative, it's very, very difficult, because if you take a market, if you have a strike price here, what I was trying to say, if I have a 16,325 strike price, and I have to do the log normal distribution of the and calculate the Black-Scholes parameters, I have a strike price of 16,325, and the market price, it's here, it's 16,100, so I have a positive parameter. But then for the same strike price, if I have to subtract the market price here, on the other side, there will be another parameter, and the jump will be so large that it makes very difficult to have a precise pricing of the option at these points. That's why the market jumps around, and you have what is called a support level, which is not the support level, it's a psychological thing. What is a support or resistance? Those are psychological factors which are basically the what is called market sentiment, or investor psychology, or trader psychology, or the market sentiment. But the thing is that the market here changes price very quickly, and so here it's very difficult to find an average price that would continue the trend or would go sideways, like the market goes sideways instead of going up or down. That's why you pinch this level and you start to have a lot of volatility again, because you are at that point where the market before changed direction very, very rapidly. So you have basically market traders which trade by sentiment, and they have a lot of call exposure to the upside, but still they have a lot of open interest put to the downside, because here it's the market goes up and down at the same time, because the market couldn't price effectively the derivative at this point. Okay, but this mathematical fact basically also explains another thing which is very important, and is that if and when basically the market goes through this area here, you will have, even if the trend is continuing down, you will have a jump of volatility, and then you will have a huge jump in volatility in the option pricing. Although the slope of the derivative of the curve, it's continuous, so the market continues to go down, and then the slope continues to go down, so it means that the function it's a continuous function. At the same level here, you can experience a lot of volatility, and then the curve, in mathematical terms, the function of price and volatility, it's continuous and goes down and starts to work through the price level and the volatility level for those prices here, whatever is the price. But then at this level you will have a lot of volatility and say, oh, because it's the support, we broke a support level. If I don't know, in market sentiment, the support level is broken. The thing is that here the function is not continuous. You don't have a continuous function. The derivative of this side is not the same as at the same price level. The delta will change very rapidly because here the market is going up, here the market is going down. So the derivative effect will change very widely the delta and the gamma, the first and second derivative in the option market for the same strike price. Okay? Because the drift effect and the volatility effect, it has changed direction, let's say. So again, when the S&P 500 on the stock market has gone back to this level, if you go and see the option chain, you will see that there are large open interest call here, a large open interest input which are below that level, or at that level, or even below that level. So that means that traders, because they go according to market sentiment, they are edging both direction. Okay, because here the function change direction, goes up, down. The pricing of the derivative here goes haywire, blows up. Now, if and when the same thing here continues to go down, remember, important is here the function, when the direction change, you don't have continuity in the function. Okay, but again, if it goes down and the line is continuous, so the function, the pricing is continuous, here, because you had this, before you have this dislocation in the option pricing, in derivative pricing, and the same level as well, you will have a jump of volatility and pricing in the S&P 500 and in the option market of the S&P 500, because the function goes again, the drift and the volatility goes again through the level where the function was not continuous, and when it breaks through, of course you will have a jump again, a widening of the spread, bid-ask spread, or a widening or a huge volatility of the delta of the put option or the gamma, there is put or call option, etc., etc., etc. Because here you had, the market couldn't price the derivative. Market change direction, the derivative market starts to price a change of direction. You lose continuity here in the function, so the derivative market struggles to price. Even if you have basically a first market reaction which is basically edging on both sides, going up and down, because people, they don't understand, they go according to market sentiment and say, oh, that is a support level. That is not a support level. It's basically you are going back on a level of price where the market changed direction in 2022. You don't have derivatives in that point of the function because the function is not continuous, the curve is not continuous, and so you have a spike in volatility again, and the market goes up. Okay, so basically the call side of the option chain gains momentum, let's say. But in real mathematical terms, if and when the stock market goes down again to this level here, where the function was not continuous, and let's say it breaks support, it hasn't break any support. It hasn't broken any support. It basically has continued pricing the S&P 500, but it has gone to a level where the function before, the same function of mu, which is the average price, and the drift element, which is the volatility, where here you didn't have a clear derivative market, which is this side or that side of the market. So even if and when the market goes down, and even if the function is continuous on the downside, here you will have a jump. And so you will have all the geniuses coming out to say, oh, we have broken support. No, you have not broken support. That's my hunch on how I look at things. So to me, it's not support and resistance. It's whether you have how the curve change and if I have sudden tight angle changes, then if the function is continuous and I have a derivative that I can price at that point in the market, or if I don't have a derivative, or otherwise, if I have a derivative, I have two different prices according to which direction is taking the market. So I have a huge spread in the delta or the gamma, whether it's the call option. If I'm writing a call option, so I'm selling a call option, or imagine if you sold a call option here, okay? So while the market was going down, you have the differential equation, which is pricing mu plus sigma, and then you have, in the Black-Scholes formula, you have basically the delta, which is the first derivative, and the gamma, which is the second derivative of the mu and the sigma. Then you have the delta of the, you sold a call option, you have the delta which is going down, so you are losing money. And then basically the market does like this. What happens is that the premium of, I said something wrong. If you are selling a call here, the delta of the call is going up, so you are losing money. But if you sold the call, so you are short the market, basically the market turns around, and then the premium of the delta of the call goes down, and then because you are short the call, you make money all of a sudden. But the jump that you have, let's say the premium of the call here is 10 cents, the market goes up, so the premium of the call here is 20 cents, and the market turns around, and then all of a sudden the call it's priced 5 cents, 0.05. So you have a huge jump in the pricing of the first or the second derivative in the option market because you have a sudden change of direction. And so that's why my interpretation is that it's a mathematical angle. Never place bet here, which is never place directional bets when you have areas where the market change direction, because that means that the option pricing, the derivative pricing, it's gone haywire, and so the market changed direction for many other sorts of reasons, which is also related to the volume of short futures or long futures and stuff like that. So anyway, thanks a lot for today. I hope to see you soon. Be well, enjoy your week, and watch my videos. Please thumbs up with a huge like, and see you soon.